Let's consider a liquidity indicator called gearing, or the debt-equity ratio. This indicator shows the relationship between liabilities and total assets. Let's have a look at an example. On the left here, business A. This is a business with relatively low gearing. Look at the liabilities, $30,000, and the assets, $100,000. So the ratio, or the formula, is liabilities over assets, so 30 over 100,000, this will be 30%. So that means of every dollar of assets, the business has 30 cents in liabilities. Compare that to business B, which would be considered to be highly geared. The formula, liabilities over assets, so this time we've got $80,000 over $100,000. So that works out to be 80%, which means of every dollar of assets, the business has 80 cents in liabilities. So there's a high level of debt in the business relative to the assets, and that business is said to be highly geared. Highly geared, a high debt equity ratio, a high proportion of liabilities in relationship to the total assets or equities. The possible problem with a business with high gearing is that you have to repay the debt with interest. So there's more debt, and usually there's interest on the debt, so we have to repay the debt with interest, and that's going to put a negative pressure on liquidity. It's going to make it harder for the business to meet its short-term cash commitments in a timely manner, particularly if the business suffers a downturn in sales. It would then find it even harder to meet the liquidity requirements associated with the debt. So high gearing is high debt, usually with interest, and that debt and interest has to be paid, and that's going to put a negative pressure on liquidity, and that's particularly the case if there's a downturn in sales activity, a reduction in the cash inflow on the business. So high debt is normally associated with a higher risk of liquidity problems. High gearing, higher risk of liquidity problems, particularly if there's a downturn in sales activity. This chart or graph shows the gearing ratio or the debt equity ratio increasing over time. The percentage is becoming greater. That means the liabilities are becoming more relative to assets. Higher levels of debt, higher gearing, more risk, particularly if there's a downturn in activity. It's going to be very hard for the business to meet its cash commitments if it has a high level of debt and there's a downturn in activity. So if gearing, high gearing, is so risky, why would some businesses have high gearing? There are a couple of potential benefits associated with high gearing. One of them is that higher gearing tends to lead to a higher return on owner's investment. And ROI, as we know, is a key indicator of profitability. So higher gearing does tend to lead to a higher rate of return on owner's investment. Let's look at an example. On the left, we have this business that has relatively low gearing. Liabilities $30,000, assets $100,000, so the gearing is 30%. For every dollar of assets, 30 cents liabilities. And on the right-hand side, the high gearing, $80,000 liability, $100,000 assets, 80%, every dollar of assets, 80 cents liabilities. Now let's assume that both businesses earn a profit of $10,000. Let's calculate the return on owner's investment. And just to make it easy, we're going to use the denominator, that is average owner's investment, using the owner's equity figures given in these two balance sheets. That's simplistic, but it's going to be sufficient for this illustration. So it would be $10,000 divided by $70,000 for the low geared business. That gets a rate of return of about 14%. And with the high geared business, there's a relatively low average owner's investment. And the $10,000 over the $20,000 denominator gives us a rate of return on owner's investment of about 50%. So the business with the higher gearing has the higher return on owner's investment. And the reason is because the same profit is distributed over a much lower denominator. Owner's equity is relatively low in a high gearing business, so the rate of return tends to be higher. So that's one of the benefits of higher gearing. It can lead to higher returns on owner's investment. Also, it can lead to higher returns on assets, another key profitability indicator. Here's a simple example. If the assets financed by the liabilities earn, say, 20%, and the interest on the liabilities is only 10%, then the business was going to increase its return on the assets. So it borrows money to buy assets. Those assets generate a higher rate of return than the interest on the borrowed money. The business is better off. So higher gearing can lead to higher levels of profitability, both in terms of the return on assets and the return on owner's investment. Higher gearing can be associated with higher rewards. The problem, of course, is if there is a downturn in sales. Less cash inflow from cash sales, less cash inflow from debtors. If there's a downturn in activity levels, higher gearing is going to be associated with higher risk. There's going to be a fall in profits because of the lower sales, and there's higher interest expense associated with the debt. So higher gearing, particularly if there's a downturn in activity, downturn in sales, is going to lead to a fall in profits. Remember, interest expense is going to be relatively high in that a highly geared business. And perhaps even more important is this negative pressure on liquidity. The business has to pay the debt and the interest, and if sales are falling, that's going to put a lot of pressure on the business to meet its normal cash commitments, including the commitments on the debt and on the interest. So higher gearing has a higher risk. If things go poorly, if sales decline, it's going to lead to a fall in profits, not only because of the sales, but because of the higher interest expense. And of course, repayment of the debt with interest is going to have an impact on the business's cash situation, its liquidity. And here's a graph that's probably worth remembering. Liquidity risk. At low levels of gearing, there's very little risk because there's hardly any debt to repay with interest. But the rewards in terms of return on investment and return on assets are going to be relatively low. As you increase the gearing, you increase the liquidity risk, but the benefit may be higher rewards in terms of return on investment, return on assets. So higher risk, higher rewards. Low risk, low rewards. The business has to balance up the benefits of higher rates of return with the possible problems associated with high levels of gearing, particularly if there's a downturn in sales activity, there's going to be a liquidity problem.